What if I told you the recession everyone's been predicting for 2025 is actually already happening right under our noses? While mainstream financial media debates whether we'll have a soft landing, hard landing, or no landing at all, the data is telling a much different story. Here's where it gets interesting. The Atlanta Fed's GDPNow model is projecting a 2.4% GDP decline in Q1 2025. Yet the stock market has only recently started to react. Let's open the wealth window on what's really happening in the economy right now. In this video, I'm going to break down the hidden signals pointing to a recession that's already begun, why Trump's economic policies might be accelerating this downturn, and most importantly, how you can position your portfolio to not just survive, but potentially thrive during this period. I've been analyzing economic data, tariff impacts, and market reactions over the past several months. And what I'm seeing suggests we're at a critical inflection point. Now this is the part they don't tell you about recessions. They're often well underway before they're officially declared. So whether you're worried about protecting your investments or looking for opportunities in a down market, let's navigate this economic uncertainty together as wealth-building teammates. The recession signals hiding in plain sight. Recessions don't announce themselves with a press release. They're typically recognized months after they've already begun. So, what signals suggest we might already be in one? First, the Atlanta Fed's GDPNow model is projecting a 2.4% GDP contraction in Q1 2025. This isn't just a slowdown, it's a significant reversal from the growth we saw throughout 2024. Second, consumer sentiment has collapsed to levels we haven't seen since 2022, according to the University of Michigan's survey. When consumers don't feel confident about their financial future, they spend less, creating a self-reinforcing cycle of economic contraction. Let's zoom out for a second. The bond market has been flashing warning signs too. After a prolonged inversion that ended in late 2024, the yield curve has shifted dramatically. The 10-year note has dropped 65 basis points in just 11 weeks, a massive reversal that typically precedes economic trouble. But here's the signal hiding behind the noise. Inflation is rising at the same time rates are falling. The 1-month and 3-month annualized inflation metrics are over 4%. This unusual combination suggests something is breaking under the surface of the economy. Let's talk facts, not fluff. The Trump administration has implemented aggressive tariff policies that are sending shockwaves through the global economy. A 10% baseline tariff on almost all imported goods. Custom tariffs on worst offenders like Vietnam at 46% and China at 104%. Threats of additional tariffs, creating ongoing uncertainty. While these tariffs were temporarily delayed by 90 days in April, the economic damage may already be done. Trade partners have retaliated with their own tariffs on U.S. exports, creating a cascading effect throughout global supply chains. Last year, I was more optimistic about the economy's resilience, but I've had to evolve my thinking as these policies have taken shape. The evidence suggests tariffs are acting as a tax on American businesses and consumers, forcing companies to pay higher prices for imported goods and components, which many will simply pass on to consumers through price increases. Here's where it gets interesting. Some analysts believe this economic disruption might be intentional. On March 9th, Trump literally said, "You can't watch the stock market," and indicated he was comfortable with market disruption in service of his broader economic agenda. Bull or bear? What's your play? Do you think these tariffs will strengthen the U.S. economy in the long run, or push us deeper into recession? Drop your take in the comments. Beyond tariffs, there's another economic force at work that's getting far less attention. The Department of Government Efficiency, DOGE, led by Elon Musk. DOGE has already cut an estimated 222,000 government jobs and terminated more than 7,200 government contracts in an effort to reduce wasteful spending. While DOGE estimates it has saved American taxpayers more than $150 billion, these savings come at a cost. Now this is the part they don't tell you. Government layoffs directly contribute to U.S. unemployment, reduce consumer spending, and weigh on GDP growth. Additionally, private companies who have lost government contracts could respond with their own layoffs, compounding the problem. JP Morgan Research recently raised the probability of a recession occurring in 2025 to 60%, up from 40% earlier this year. Even with the latest unwinding of some tariffs, what remains is still considered a material threat to growth. The ex-ante tax hike from remaining tariffs amounts to nearly $1 trillion, or 3% of GDP, making it potentially the largest tax increase on U.S. households and businesses since World War II. What's your wealth window looking like right now? Are you positioning defensively? Or do you see opportunity in this potential downturn? So how can you position your portfolio for success in uncertain times? Now, this is absolutely not financial advice, just the opinion of a humble YouTuber, but let's talk through a few ways. Let's zoom out for a second. Recessions create both risks and opportunities for investors. Here's how you might consider positioning your portfolio. First, consider increasing your cash holdings. Cash may not be exciting, but it reduces market risk and provides financial flexibility if a recession creates buying opportunities. Plus, you can still earn more than 4% interest on a one-year certificate of deposit right now. Second, look at defensive sectors that tend to outperform during recessions. Utility stocks, healthcare stocks, consumer staples stocks. These sectors are considered defensive because their earnings tend to be insulated from economic cycles and swings in consumer confidence. Third, certain individual stocks have historically outperformed during past recessions. Walmart, Netflix, and T-Mobile are examples of stocks that beat the S&P 500 in both 2008 and 2020. But remember this, since 1946, the S&P 500 has dropped an average of 32% from its highs during bear markets, but has taken an average of just 23 months to fully recover those losses. For long-term investors, recessions can create excellent buying opportunities. Challenge me in the comments. What did I miss? Is there a recession-resistant investment strategy you're implementing that I didn't mention? So, is the 2025 recession already here? The data suggests we're either in the early stages or teetering on the edge. The combination of negative GDP projections, falling consumer sentiment, inverted yield curves, and disruptive trade policies creates a perfect storm for economic contraction. But here's the thing about recessions. They're a normal part of the economic cycle. Since World War II, the US has experienced 12 recessions. And each time, the economy and markets have recovered and reached new heights. For investors with a long-term perspective, the key isn't to panic, but to prepare. Understand your time horizon. Ensure you have adequate cash reserves, and consider whether certain parts of your portfolio might need adjusting. Drop your mindset in the comments. Scarcity or abundance? Do you see the potential recession as a threat or an opportunity to position for the eventual recovery? If you found this analysis helpful, make sure to subscribe to Wealth Window for more insights on navigating economic uncertainty. And check out my video on investing for beginners to better understand how to protect and grow your wealth during market downturns. Until next time, keep your window open, because wealth isn't luck, it's strategy. Stay sharp, stay curious.